We are talking about pass-through taxation, which is a very interesting concept in business taxation. And this is a concept that really identifies the sole enterprise as a business category. And so the question is, what is pass-through taxation? All right, so let's take a closer look at this. So it says here, when the taxes of a business are passed through, and that's where the name comes from. When the taxes of a business are passed through, the taxes of the owner. Right? So here then, the owner and the business are the same. There is no separate entity. The owner is the business is the owner. It says here, this is an acknowledgement of the concept of no separation, right? You have no separation between the business and the owner. So here is the business and here is the owner, right? The business, right? So there is no separation between the two. No separation. So the business is the owner is the business. They are one and the same thing, so to speak. All right, so this is an acknowledgement of the concept of no separation in the eyes of the law between the business owner and the business, right? In other words, the business is the owner and the owner is the business. And that's sole enterprise category in terms of business registration, business category, sole enterprise category. And so it says here then, in this case, the business is not its own entity, unlike corporations, right? Corporations are their own entity, they stand alone. They are not merged with the founders, with their founders. They stand alone once they are created. All right, so in this case, the business is not its own entity. That means it's not a separate entity from the owner. As an example, if the business secures a loan from the bank, the loan will be in the name of the owner, not in the name of the business, right? So if it's a corporation, the loan is in the name of the corporation. ABC Corporation, for example, XYZ Corporation, for example, not in the name of the founders. But in this particular case, sole enterprise business, the loan will be in the name of the business owner and not in the name of the business. This is not the case with the corporation that are deemed entities in the eyes of the law. So corporations stand alone. Corporations stand alone. Once they're created, they stand alone. There's a separation between them and the founders or the founder, right? There's a separation, clear separation. They stand alone. And if there's a loan taken from the bank, the loan is in the name of the corporation, not in the name of these individuals, the founders, right? These individuals become employees of the company, and they draw a salary from the company. The company stands alone. If the company declares bankruptcy, the company alone is bankrupt, not the owners. Owners can move on to other ventures. But not so when it comes to sole enterprise. In the case of the sole enterprise, the taxes of the business are passed through the taxes of the owner, right? So if the business makes $100,000 in any given year, that $100,000 is merged with the income of the business owner. Let's assume the business owner works elsewhere and only operates the business on the weekend, and the business owner makes $50,000, right, from the other job, makes $100,000 from the business. Yeah, well, the salary of that business owner is $150,000. So the business owner pays taxes on $150,000. This is pass-through taxation as a concept, as an idea in sole enterprise business. All right, so it's a very important concept that differentiates sole enterprise from companies that are incorporated, that stand alone. They are their own entity in the eyes of the law, where they pay separate taxes. So in this example, the company will pay a separate tax, right? And the founders will pay a separate tax. Not so when it comes to sole enterprise. Sole enterprise, the sole entrepreneur, this is sole enterprise, sole entrepreneur, the business taxes are paid through his own personal taxes. That's pass-through taxation.